Good morning, accounting students. So we're looking at the fourth section of your notes. This section is the financial management section. So it's where we kind of put everything together. We've reversed the process now. We're looking at how we are actually targeting or making decisions about how our company should be funded, what assets we should invest in. The specific little video is looking at the investment decision. So we're deciding which assets we should be purchasing. So this is investments. We've already looked at the financing side. So in the financing side, we're deciding what combination of debt and equity we should be using, what the costs of those are, and what is the overall, what we call the weighted average cost of capital. In other words, the average return that these investors want from any decisions. And the section that we're still going to look at next will be working capital, where we're specifically looking at both current assets and current liabilities. Right, so when we're looking at assets, we have to go back to the definition of an asset and say, what is an asset? Well, it's a resource controlled by an enterprise giving rise to future inflows of economic benefits, in other words, cash. So if we're thinking about an asset is something that's going to give rise to those future cash flows. And so if we think about the value of an asset, well, the value of an asset must be logically the present value of those future cash flows added up together. So we take those future cash flows because they're happening in the future. We want to work out what they are worth now. So we have to work out the present value. Remember how we work out present value? It's future value divided by 1 plus I to the power of n. Well, what do you think that I should be? Well, it's what the investors are going to want. What do the investors want? Well, the investors want the weighted average cost of capital. So it's most likely going to be those future cash flows discounted by a required rate of return, which will probably be the weighted average cost of capital. In fact, that gives you the first technique that we're going to look at, which is known as the net present value. And essentially what we're going to do is we're going to take those future cash flows, discount them back at that required rate of return, and we're going to say, what does it give us? How much do we get back? And as long as we get back more than we put in, it's a good investment. Even if it's only $1 or 1 cent. And you might say, like, 1 cent doesn't sound like a whole lot. No, it doesn't. But if we think of the process of discounting those cash flows back, we're taking off our required rate of return. So we've already banked that required rate of return. And anything we get back beyond that is a bonus, and therefore makes it a good investment. So that is known as the net present value technique. We're going to look at that next. However, there are a couple of other techniques out there. There is techniques or are techniques known as paybacks, where essentially we will say, well, if we have to invest $100 and we're going to get a return, how long does it take us to get us $100 back? There's a modified version of that where we look at discounted payback, where we look at the future amounts, but the present value of them and how long will it take us to get our money back. There's something called average accounting rate of return, where we take the average profit we get from the project and we divide that by the average investment. So I'm going to call that average accounting return. That technique obviously ignores time value of money, so it is very limited. And then finally, there's another technique which is known as internal rate of return. And what internal rate of return does, it says, well, you know, if I've got 2 projects I have to choose between, I can use the net present value technique and see which gives me the biggest return in excess of my required rate of return. But what happens if I have to choose between the 2 of them? And there's, or maybe multiple projects, which ones are the best? So which ones are giving me the highest rate of return? Obviously, you know that should give you, that should raise some question marks. There may be limitations with that. But that is the internal rate of return. Good news is if you're doing this online, you can look up online calculators on the internet. You can use Excel. It's got internal rate of return calculation built into it. You can go and use your calculators. Tier 83s, 84s, you hit applications, finance, and then instead of picking the first one, which is time value money solve, if you go down to like 7 as net present value, and I think 8 on that list is internal rate of return. Okay. Let's take an example. So I'm going to take the example from your notes. Here we have a project, costs us $1,000, and it's going to give us back $400 in the first year, $400 in the second, $400 in the third, sorry, $300 in the third, and $200 in the fourth. And we want to know if this is a good investment. Okay, so in terms of the principles of time value money, we need to know what those future amounts are worth today. So the first thing we're going to do is work out the future amounts. And I've pre-done this. I've worked out the present value of $400 today, and that's $336, and the same for the next two amounts. Let's just go and look at that calculation of the $336. How do you do that? Present value is equal to future value, the 400, divided by 1 plus I to the power of n. Okay, what is my I? Well, in this case, they said to you, the company's weighted average cost of capital is 10%. So it's divided by 1.1, because that's 10%, 0.1. What is n? It's 1. 400 divided by that gives you 336. How do I get the next number? Well, it's the 400 for the next year, but it's not to the power of 1, it's to the power of 2. And then obviously I can keep going for each of them, but obviously that then becomes 300, that becomes 200. And you'll notice that I've done the calculation, even though in this case, the required rate of return is 10%. I've done the calculation in the notes for 15%, and we'll talk about that in a few minutes' time. So let's focus just on net present value and 10%. So this is number 1. Okay. So I want to go and add up those future amounts and see how much it gives me. So if I go and add them up, I got 363 plus 330 plus 225 plus 136, and it gives me 1,055, so roughly 54.55. So how much do I get out of this project? It cost me 1,000, I get back 1,055 at 10% discount rate, which means I get a bonus of $55 out of this project. So I not only do I get my money back, but I get an extra $55. So if my weighted average cost of capital was actually 10%, this is giving me back 10% plus an extra $55. So I would accept that project. Yes. Okay. So the next technique I'm going to focus on is a slightly complicated one. It's a lot easier when Excel does it for you or your calculator does it for you, but it's known as internal rate of return. Okay. And essentially what we're doing is we're playing around and we're saying, what discount rate would give me a net present value of 0? In other words, what discount rate gives me exactly back the money I put into the project? Because that's the return that I'm getting for this project. So what your calculator will do is it will try different discount rates and see what the net present value of those cash flows are until it gets to a net present value of 0. And it can do it in a couple of fraction of a second, and it can work it to 10 decimal points. You will see if we try to do it, it's actually quite a lot of work. So I'm going to draw a little bit of a graph here to explain what your calculator is trying to do. And on this graph, I'm going to draw on the vertical axis net present value, and I'll have 0 in the middle. And on the x-axis, I'm going to draw, let me just give myself a little more space here. I'm going to have discount rate. So there's 10%, and over here I'm going to have 20%. Right about there's 15%, and I'm going to have 30% out here. Okay. Now I know at a 10% discount rate, my net present value is plus 55. So let's just say that's 100. So I'm going to be at 55, which is right about there at 10%. So clearly, you know, I've still got a positive net present value. So I'm going to need to go and pick a higher discount rate, okay, to see if that brings me either down to 0 or to negative. If it's negative, I've gone too far, and then I've got to go back a little bit, and I've got to keep trying. Obviously, I'm not actually going to do that. I'm just going to get two figures and kind of get an estimate of where it crosses the zero intercept. So I chose 15%. You could choose 20%. It really doesn't matter. Just pick a number that is significantly higher than 10%. And if I add up these amounts over here, I've got 347 plus 302 plus 197 plus 114, which gives me a total of 960. Okay. So I put 1,000 in, I get 960 back at 15%. That's going to give me negative 40. In other words, it doesn't give me my money back. I've got, if that's a plus, I'm going to have a negative net present value. Let's go figure out where 100 is. So there's 40. So round about there, minus 40. Now again, I haven't hit the mark, so I'd want to go maybe down to 11, then up to 14% until I get closer and closer. Or in this case, because I'm not looking for a very accurate answer, I can just draw a line between the two and say, where does that intercept the x-axis? What rate is that? And my answer is plus minus 13%. Okay. So if I asked you to do that, this is the process you would go through, or you just go type those numbers into your calculator and hit internal rate of return. You'll get the answer to it, and a lot more accurate. A couple of things you should know about internal rate of return is that it is possible if you have weird cash flows, positive and negative ones, that there could be more than one answer. And again, we know from our performance evaluation that managers could be prone to picking very high value projects and not maximizing the total return for the investors, which would be your net present value. So net present value is always the best technique. Okay. I told you that there is accounting rate of return, not a very good technique. You just take the average profit, okay, which here would probably be around about, just less than, probably about 400, round about there. And you take it, divide that by your average investment. That's your initial. Your average investment will, over 4 years will go down to zero, so probably 500. So you have probably like 400 over 500, which looks like about an 80% return. Great, but it doesn't include time value money, and so no one really uses that. There is one other technique that you need to know about, and that is known as the payback technique. And you can either look at the actual cash flows or you can look at discounted cash flows. I'm just going to look at the actual. This is the last one. It's called the payback. So in the payback technique, what I want to do is I want to know how long does it take me to get my $1,000 back. So I start out in year one and say, okay, I've got 400. Then I look at year two. I've got another 400, so I'm up to 800. So how much more do I need to get back to my original amount? And the answer is, I need another 200. Do I get 200 in the next year? Yes, I do. In fact, I get 300. So if I need 200, what stage during year three will I get that 200? Well, if I made 300 in a year, it's probably 2/3 of a year. So what is my payback period? 1, 2, and about 2/3 of a year. So my answer is about 2.67 years. Is that good or bad? Well, it depends on your company. You will have a minimum payback period. And if your answer was 2, and this only gave you money back in 2.6 years, not good enough. But if your payback period was 4 and you got the money back in 2.67 or 2 and 2/3 years, great, good project, you would accept it. Okay. And as I said, there is a modified internal rate of return. We're not specifically going to look at that simply because of time constraints. But you do need to know how to do payback, internal rate of return, and net present value for this class. Okay, thank you very much. And we will have the next video on working capital shortly.